Hi, this is Todd Baker, your certified mortgage planner, and in this video we're going to discuss mortgage insurance, which is different than homeowners insurance, and it's known by different names. So I'm going to explain the two basic types that are out there. In fact, there's really only two types. There's private mortgage insurance, or PMI, and that's associated with a conventional loan type, Fannie Mae or Freddie Mac loan type, for loans in which you put less than 20% down. Okay. The other type is mortgage insurance, just MI, and that is with an FHA loan, and that's required on all FHA loans. There's an upfront portion that gets financed into the loan, and then there's a monthly portion that you pay as well on FHA. So let's talk real quick. I want to show you how it works on a conventional loan real quick and compare it to FHA. But I want to take a brief moment and also talk about, like, philosophically about mortgage insurance premium, because there's some important points to make. Many times you will get advice from family and friends that say, hey, whatever you do, don't pay a PMI. That just pays the bank for lender insurance. And that's true. What mortgage insurance is insurance that covers us as the lender against you not paying your mortgage and going into foreclosure. It covers a part of that loss for us. But just because it does that, the mindset that it's bad is not correct. It's neither good nor bad. It's all relative to what you have. So for example, to avoid PMI, if you need 20% down, but if it takes you 10 years to save that money, you could have bought a house with 3% down with mortgage insurance and had $100,000 to $150,000 worth of equity to go buy that other house without PMI if you had bought a house. So you always buy real estate. The time to buy real estate as part of your investment portfolio is always right now. It's the number one best investment as an American consumer that you can make, because you are taking money that you would normally route to rent, right? You take, okay, I have to have shelter. I'm paying money towards rent each month. You're now routing that towards another shelter, but on this shelter you own. It goes up in value and you're paying the note down. So mortgage insurance allows you to what's called leverage your money. That means take a small amount of money and leverage it up against a big asset. That's why real estate is such a great investment. So there's nothing wrong with mortgage insurance at all. So that's number one. Number two, here's the basic difference. I'm going to show you the MI chart for conventional loan. So on a conventional loan, the mortgage insurance, and there's about 6 mortgage companies. They all have about the same rates and fees. They update them. This is fact from November 18th. They get updated about every 6 months or so, their fees. But what they show, first of all, it shows right here, it shows loan to value. What that means is that's 3% down, 5% down, 10% down, 15% down, and then, and below. So basically, once you get to 20% down, there's no MI required. Okay. And this is for, 30 years plus. And then you see it has this coverage. You always have to get the top line coverage you see highlighted. So if it's 3% down, you need 35% coverage, or 30%, or 25, or 12. And then here's the key. Then you got your credit score, these credit score buckets. So it's a grid. So let's say your score is 760 and you're putting 5% down. That 0.38, what that is that's multiplied by the loan amount divided by 12. In other words, there's a calculation. So it's to keep it simple from a consumer's point of view. The lower that factor, the lower your payment, right? So here's the thing. You can see that with 5% or 10% or 15% down, lower payment. But as your score drops, look what happens. The payment starts going higher. And if your score drops with the lower down payment on the 15%, it's not so bad. But 10% it goes up higher. 5% it goes way higher. So right here, if you see it's 680 and below, the percent for FHA is 0.85 with 3.5% down for the life of the loan, and then FHA is 0.8 if you put 5% down, and it cancels in 11 years. So really, if you get 680 and below, and you're putting only 5% down, FHA starts to become an attractive option, because Fannie Mae also adjusts for the interest rate as well, where FHA is much more forgiving. So it's not 100% certain, but it's, in other words, this isn't an ironclad rule, but generally 680 and below is usually FHA is a little bit better. Once again, that's where a trusted advisor comes in, where that understands your budget, your short, long-term goals, and we can look at the entirety of it. One other thing about PMI is that on private, or the PMI for conventional loans, all of it cancels. There's a federal statute, Homeowners Equity Protection Act, that governs how it gets canceled. So basically, Once you have 20% equity, if you've made all your payments for at least a year, you can order a second, order a new and pay for a new appraisal. And if it shows 20% value, it'll remove your PMI. The other way is it automatically goes away once you pay it to 78%. But here's the thing. What I can tell you what happens to most people is 5 to 7 years in. 7 years is the average time you spend in a home. And so most people end up at the 7-year mark having enough equity to sell the house, put a larger down payment, and not have PMI anyways. So it's not a bad thing at all. If you stay in the house a while, you can get rid of it. All my clients that have stayed in their house end up getting rid of their PMI eventually, either through a refinance or through doing an appraisal. FHA is a little bit different. FHA, one of them stays for the life of the loan. If you put a larger down payment, it stays 11 years, and there's no way to get rid of it any sooner. So, like I said, it's not a bad loan. It just depends on your credit score and your situation. There are other ways to save money. There's a split premium. There's also a single premium where in certain cases you can pay the MI up front and not have that monthly payment. But the premiums are large, and they're usually hard to justify doing that. I used to do that a lot more earlier. Several years ago, the premiums were lower, but these days the premiums are much higher for what they call the single MI. So it's not a big deal to have. It does go away eventually. And what you really need to be working with is the right advisor that gets you into the right program. That's really where you're going to save money, is getting the right program for your short and long-term financial needs. So thanks so much. Please feel comfortable reaching out to me if you have any questions. Bye-bye.